Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good morning. Well, we have run you through all the stocks that we're tracking today. Let's get some more fundamental analysis going. We have Dipan Mehta, Director Elixir Equities, who joins us on the show. Dipan's not yet in his holy outfit, but tomorrow I'm sure he's going to be a lot more colorful. Hi, Dipan. Good morning. Good to see you in and happy festivities in advance. It's a long weekend, a lot of color. Hopefully the color is green today. Let's talk about a couple of stocks, though. Yesterday, the problem was on tech. A couple of brokerages came out there and they said, hey, watch out. The growth that you all were expecting in FY26, it isn't going to be that good. Morgan as well as Motilal, both of them did point that out. What do you think? The index itself, I think, is corrected close to 20% from the top. But a couple of stocks yesterday, I recall Coforge, from the lows of the day, there was some buying. Your approach to tech and what do you like from here?
Yeah, Nigel, good morning and thank you for hanging on your show and happy Holi to you, entire CNBC team and all your viewers. Looking forward to at least a holiday, if not celebrating Holi actually. But coming specifically to your question, yes, I think that the chances of US going into recession are increasing and that doesn't spell good news for Indian tech sector. In any case, I think one has to be extremely selective when it comes to software companies. And there are only a handful of companies, 3 or 4, which are able to sustain the kind of 15% thereabout growth rates, which is the bare minimum required for an investor to consider a stock. So by and large, I think investors should remain underweight on the technology front. And if Trump makes any changes in policies regarding this particular industry, then that will sour the sentiment even further. So I think it's time to be underweight tech, at least large cap tech, which has gone nowhere in the last 5-7 years or so. They have got stagnant growth rates if you remove the kind of rupee depreciation benefit which they have got. So from that point of view, I think one is to be underweight tech.
What about banks, Dipan? We are seeing some positive movement in the Indian macros. The inflation is cooling off faster than people expected. The growth is coming back. We don't know whether it's structural yet or not. Both these are positive from a bank standpoint. Would you look at building up positions in banks now?
Good morning, Mangalam, sorry. Yes, of course, I don't think it's structural, but we are going to see a cyclical up move in the entire bank and NBFC sector. And of course, we are quite positive on banks in the medium term, short to medium term as well. There's a good trading rally. And I think March and June quarters also will have the benefit of base effect. But the best bang for the money will come in NBFCs. And that sector also has been underperforming, I think, right from October 23 onwards or so. And these companies will benefit not only from increased liquidity, but the risk weightages which were changed by RBI, that also will ensure higher credit flow to the NBFC sector. And there are a lot of aggressive managements over there. Their collection efficiencies also may improve. So very positive on the NBFC space, more than the banks also. And I think one should go for those diversified lenders, be it Bajaj Finance, L&T Finance, and some of these companies which are into many products, not just single product like maybe just vehicle finance or housing loans.
Dipan, in the pharmaceutical pack, you said that large cap IT, not particularly looking very good, mid cap IT either. Banks, you're selectively constructive on, more positive on NBFCs. Where do you stand on pharma?
Yeah, Mangalam, I was very positive on pharma right until Trump came into the presidency. And now there's suddenly a fresh wave of uncertainty because if he starts to put customs duty on pharma imports, then whatever the industry may say, it's certainly going to mar the sentiment within the sector and it's going to impact revenues and profits. So till we don't have certainty around Trump tariff, I would like to avoid pharma for the time being. Also, domestic pharma sales have slowed down. I think the latest numbers showing about low single-digit type of growth rate. So from that point of view, also the fact that pharma has done very well over the past 4 to 6 quarters. I just like to be a bit cautious in the pharma sector. Although long-term prospects are great, but let this uncertainty around tariffs be over and done with before we can take a more positive approach to that sector.
Okay, all right. Let's talk about the big boy, Dipan. What's the view on Reliance Industries? And Jio Financial Services is going to be coming into the Nifty. Bulk of its value is derived from Reliance Industries. And then there is, numerous triggers for that stock. Given that, would you play Jio Financial Services or would you simply play Reliance itself?
No, neither of them, Nigel, because growth rates are slowing down over there also. And frankly, Geo Financial has been able to scale up their core lending operations as well as I think the street and we are expecting. And within the NBFC sector, looking at the risk return profile, the valuation, there are many choices over there. So I would avoid both these companies. And what is happening in Reliance is that gradually that holding company discount is coming in because now it seems most likely that they will do IPO for the mobile telephony business as well as for the retail business. So then investors may go for these companies rather than Reliance Industries, and we're not great fans of holding companies as well. So from that point of view, I think it's best to avoid Reliance Industries as well as Geo. Great companies, no doubt about it. But from an investment perspective, I think it's just a hold or wait and watch.
What about the consumption space? I mean, even in the macro data, the only thing that did not stand out was, or rather did not grow as others, was the consumer non-durables, which implies consumer staples itself. Are there signs of any recovery? Is there sign of any sort of value purchase or maybe protect your capital in the consumer staples?
Mangalam, I think FMCG is a sell at every rise. The industry volumes have come off significantly. The MNC FMCG stocks, which have been great wealth creators so far, their growth rates, volume growth rates are 2 to 4% or so, and that doesn't really impress us. And a lot of categories have also become mature over there. So within the consumption space, you need to expand the spectrum, go more onto different sectors like hospitality, aviation, retail, healthcare, entertainment. I think there are many choices over there, consumer durables, many choices over there rather than sticking with FMCG.
Okay.
All right. No, just a final question then. If you had to deploy your money, say 100 rupees, how would you distribute it across sectors? Because you've been positive on financials. You can't put 100 there, right?
4 sectors. Banks, NBFCs, engineering, construction companies. I would say third would be to an extent, cement. You may find it surprising that I'm actually recommending cement companies over here because I think that there could be a trading play over there. And lastly, I think domestic consumption-oriented companies like maybe which are into retail or maybe aviation, hospitality. So these are the 4 sectors where I think investors should deploy most of their portfolio.
In what weights?
Focused. I think cement would be 15%, the rest would be all equal, I guess.
Wow, Dipan, it's been a long while since you liked my cement stocks, but good. Happy to see some optimism, but actually you've been hinting at that for the last few times we've interacted after, I think, a couple of years where you didn't want to look at metals or cement. Good. Very quick word on IndusInd Bank because that stock will continue to remain in focus, right? The trust factor has weighed on the stock. But now the argument is that 50,000 crores of market capitalization, where you have a business book of more than 7 lakh crore, as Abhishek has told us, how much more can it fall? And if the promoters are serious about infusing money, that could support as well at the time to come. Your take?
First of all, Nigel, we have been shareholders of IndusInd Bank and we really feel the pain of such massive underperformance. And normally I don't average, but this time I'm tempted to average just because of the valuation. I think they're so attractive at 7 times or thereabout. But I don't know. I'm just thinking about it and mulling about it. See, whatever problems are there, that's 1 quarter profits. And overall banking industry also is looking up. So, IndusInd Bank, which has been a quality player in the past, may recover lost ground. So just from a valuation perspective, I'm tempted to average, but I haven't made up my mind. And it's just a disclosure that we may be looking at buying the shares. And in any case, we have an investment position in the company.
All right, we take that point.